This is Value Investing. I'm your host, Jun Kim. In this podcast, you'll learn everything related to value investing. Hello, fellow investors. Welcome to another episode of Value Investing. On today's show, what I'm going to talk about is 2018 annual letter from Berkshire Hathaway. So Warren Buffett writes this letter every year, and he puts a lot of time into putting together this letter. So I thought that it'd be nice to go over this letter on today's episode. So there are 5 items that I'm going to touch upon on today's show, and I'm so excited to go over them because it is advice from legendary investor Warren Buffett. So before we get started, let me just give you a quick disclaimer, as always, that this podcast is for entertainment purposes only, and it is your responsibility to consult with your investment professional for any investment decisions. So without further ado, why don't we get started? So as I mentioned in the intro, we're going to talk about 5 things in 2018 Berkshire Hathaway annual letter. So this is the shareholder letter Warren Buffett writes every year to his shareholders. And what's quite interesting is that Warren Buffett doesn't hold quarterly calls and anything like that with Wall Street analysts. And that's what happens to a lot of companies on Wall Street. And that's not the case for Berkshire Hathaway. So instead, what Warren Buffett does, he writes this annual letter, shareholder letter to shareholders. And also, he holds annual meeting in Omaha, Nebraska. And a lot of people flock to Nebraska in order to see Warren Buffett. And he answers virtually all the questions that individual shareholders have in their mind. So that's quite different from what other companies do for their quarterly calls and things like that. So why don't we get into the 5 topics that I want to discuss on today's show. So let me just go over them briefly and let's get into the details. The first topic that I want to talk about is GAAP rule that requires companies to report their stock portfolio mark to market. So Warren Buffett complained about this new rule because it doesn't make sense to him and Charlie Munger. So I'm going to get into that later. The second topic that I want to talk about here is the practice of using the book value in order to measure Berkshire Hathaway's intrinsic value. So Warren Buffett, from this letter on, started to abandon this practice, and he laid out his rationale for that. The third thing that he talks about in his letter is Berkshire Hathaway's intrinsic value calculation. Berkshire Hathaway holds a lot of companies, so it's quite complicated to calculate intrinsic value of Berkshire Hathaway. But he said that it's not that bad if you group them together. So that's what I want to talk about on today's show as well. The fourth thing that I want to touch upon is funding sources for Berkshire Hathaway. Berkshire Hathaway has traditional funding sources like other companies, but it also has untraditional funding sources that do not exist in other companies. So that's something quite interesting to talk about. And lastly, we're going to talk about the American tailwind. So this is economic power that American companies have. And Warren Buffett basically have very positive view about the future prospects of America. So those are the 5 things that we're going to touch upon on today's show. And let's just get into each topic and talk about the details. So the first topic is the new GAAP rule. So this new GAAP rule requires companies, public companies, to report their stock portfolio mark to market every quarter. So this is going to particularly produce interesting results for Berkshire Hathaway because, as you know, Warren Buffett has a huge stock portfolio for Berkshire Hathaway. This produces wild swings in the bottom line. It actually goes down to Berkshire Hathaway's income statement every quarter, and Warren Buffett thinks that this doesn't make any sense to him. Well, he laid out some examples. In 2018, the first quarter, Berkshire Hathaway reported $1.1 billion loss. Second quarter, $12 billion profit. Third quarter, $18 billion profit. And fourth quarter, $25 billion loss. So it's a huge swing quarter over quarter, while many businesses under the Berkshire Hathaway umbrella had produced consistent and satisfactory operating earnings in all quarters. It's not just one quarter and all quarters. So if you purely look at financial statement, then you would have gotten the impression that Berkshire Hathaway business is not, in a stable condition. It actually produces wild swings in profits and losses every quarter. But that's not necessarily the case. If you look at a lot of businesses Warren Buffett purchased over the course of his career, they produce very consistent earnings quarter over quarter. And if you purely look at financial statement, you probably wouldn't be able to calculate intrinsic value in a correct manner. So focus on operating earnings, that's what Warren Buffett said, and pay little attention to gains and losses of stock portfolio. So that's the first topic. I agree with Warren Buffett, and it actually makes the analyst's job harder because they have to carve out this stock portfolio and try to see how they can look at the operating earnings instead. And it actually makes it hard for us to evaluate a company like Berkshire Hathaway because it has a lot of stocks in its book. The second topic that I want to talk about here is the practice to use book value as a measure to evaluate the intrinsic value of Berkshire Hathaway. So Warren Buffett decided to abandon this practice going forward because of the following reasons. First, Berkshire Hathaway has gradually morphed from a company whose assets are concentrated in marketable stocks into the one whose market value resides in operating businesses. And second, while equity holdings are valued at market prices, operating companies are reported at book value that is far below their current value. And lastly, over time, Berkshire Hathaway will be a significant repurchaser of its shares, transactions that will take place at prices above book value but below the estimate of intrinsic value. So each transaction makes per share intrinsic value go up whenever this type of stock repurchase happens, but it actually makes the per share book value go down. So this combination causes the book value scorecard to become increasingly out of touch with economic reality. So he laid out three reasons, as I just mentioned, and he decided not to make use of book value as yardstick in order to assess intrinsic value of the company. So if you look at Warren Buffett's annual letters, always he looked at the change in book value from year to year, and then that he started his annual letter from that change. But he is not going to do that anymore because of these reasons. So that was the second topic. And third topic he's talking about in his annual letter is with respect to intrinsic value calculation. So here he said that a lot of analysts focus on the details instead of looking at the overall picture. So since Berkshire Hathaway has a lot of businesses under one roof, it's extremely hard for anyone to assess, with certain accuracy, the intrinsic value of the company. Warren Buffett gave us some useful advice here. He said that focus on the forest and forget the trees. So what he's saying is basically just look at the things in groups instead of looking at the details of each company that Berkshire owns. So he said that there are 5 groups that you can focus on. And whenever you evaluate the Berkshire Hathaway stock, you have to group them in 5 groups. And that's going to help you come up with intrinsic value. The first group is non-insurance businesses that Berkshire controls. These subsidiaries earned $16.8 billion last year, and it's pretty much like everything because Berkshire Hathaway owns a lot of different kinds of businesses and he wants to group them together here in one group. The second group is a collection of marketable equities. So Berkshire Hathaway owns a lot of stocks like American Express, Apple, Bank of America, Coca-Cola, and Wells Fargo. And these are the companies that are reported at market value, mark to market. So you can evaluate this company quite easily because you can just look at the market value. And Warren Buffett mentioned share purchases that these companies make. And one example is American Express, because American Express ownership was 12.6% for Berkshire Hathaway 8 years ago. But now it actually went up to almost 18% without Berkshire Hathaway buying a single share during that time period. That kind of ownership increase happened because of stock repurchases by American Express. So stock repurchases actually benefit quite a lot for existing shareholders. And since Warren Buffett and Berkshire Hathaway are usually long-term holder of a lot of stocks, they actually benefit quite a lot from ownership perspective. The third group that he mentioned here is the companies in which Berkshire share control with other parties. So one good example is Kraft Heinz, and Berkshire Hathaway owns 26.7% of Kraft Heinz along with 3G Capital. So if you combine the ownership of 3G Capital and Berkshire Hathaway, I think they're a little bit above 50%. So they actually have controlling share of the company. The fourth group that he mentioned is the treasury bills and other cash equivalents. If you look at Berkshire Hathaway's balance sheet, Warren Buffett said that it wants to own enough amount of cash because Berkshire Hathaway is kind of in the business of insurance and it wants to make sure that at least Berkshire Hathaway owns $20 billion. But if you look at the current balance sheet, it's about $112 billion treasury bills and other cash equivalents. And he wants to deploy this cash to somewhere more productive because right now, if you look at treasury bills, they don't really produce a high interest. And that's not what Warren Buffett likes. But he cannot find really large acquisitions to which Warren Buffett can invest this money. The last group is insurance. But before we get to the insurance, let me just reiterate the four groups that I just mentioned. The first group is non-insurance businesses, and the second group is a collection of marketable equities, and third group is the companies in which Berkshire share control with other parties, and fourth group is treasury bills and other cash equivalents. And Warren Buffett said that add the first four groups that I just mentioned and subtract an appropriate amount of taxes eventually payable on the sale of marketable securities. And that's how you derive intrinsic value for the first four groups. The final group is very unique and it actually is very important and crucial for Berkshire Hathaway, which is insurance businesses. And much of the ownership of the first four segments and first four groups is financed by funds generated from a collection of exceptional insurance companies that Berkshire Hathaway owns. And if you look at the secret of how Warren Buffett has made tons of money for his shareholders, the secret is insurance businesses because insurance business has something called float. So float is the money that insurance companies has right now, and it's not insurance companies' money, but it's just the money that insurance company holds for its policy holders. But later, insurance companies has to pay out this money to policyholders in case of certain accidents or certain events stipulated in the contract. So the beauty of this business model is the fact that insurance company can hold this money for a long time. And it's quite good for someone like Warren Buffett because Warren Buffett can make tons of money. If you look at the first page of annual letter, then you'll see that Warren Buffett was able to produce approximately 20% annualized rate of return over 40 years time period. I don't even know if 40 or 50 years time period. And such money that you don't have to pay to policyholders, called float, can be used to invest in various companies for such a long time. And Warren Buffett is perfect person to utilize this type of cash and money and make tons of money for his shareholders. So that's the float that insurance company holds, and as long as there's underwriting profit for insurance companies, it actually is cost-free. The fourth item that I want to talk about as it relates to 2018 annual letter is funding sources that Berkshire Hathaway has. So if you look at traditional companies, usually they have two funding sources. The first funding source is debt, and the other one is equity. So those are the two traditional funding sources. But if you look at Berkshire Hathaway, there are two additional funding sources that Berkshire Hathaway uses, and that is actually quite advantageous for Berkshire Hathaway shareholders. So the first funding source, as I mentioned, is the debt, and this is quite typical. A lot of companies issue debt and bonds in order to finance some activities that they are engaged in. The second one is equity capital, and a lot of companies retain certain earnings in order to maintain their business or in order to grow their businesses into different areas and things like that. And those are the quite common sources for a lot of American companies and also international companies. But let me just tell you two additional sources of money for Berkshire Hathaway. The first one is a float that I just mentioned. So float is reported as a huge net liability on the balance sheet. If you took accounting class before, that you'd consider liability as a bad thing for, shareholders and for the company. But even though the float is reported as a net liability on the balance sheet, actually it has more utility to Berkshire Hathaway than an equivalent amount of equity. What I mean by that is, since the float is cost-free, because most of the insurance businesses on the Berkshire Hathaway generate underwriting profit, which means Berkshire Hathaway doesn't have to pay any interest on this float to policyholders and to anyone else. If there's underwriting profits for the float, then it means that Berkshire Hathaway is getting paid to hold the money. So that's a huge win for Warren Buffett, because Warren Buffett has a special ability to generate compound interest on this float. And that's how he got so rich and how he made Berkshire Hathaway shareholders so rich. So that's the third funding source that other companies do not have. And the final funding source that Berkshire Hathaway has and other companies do not have is deferred income taxes. As of this quarter, Berkshire Hathaway has about $50 billion deferred income taxes. And this is the liability that you will eventually pay to the government. But in the meantime, it is interest-free. So you don't have to pay any interest. This is also recorded as liability, but it's actually better than liability, but because you don't have to pay interest, just like float. And approximately $15 billion is coming from unrealized gains in the equity holdings. And approximately $28 billion is from depreciation of assets such as plant and equipment. Let's think about unrealized gains in the equity holdings, because as an investor, I know that if I want to make a lot of money in the future, then I know that I have to compound my money over the course of my life. And if I want to do it effectively, then I have to be a long-term investor, because if I sell my stocks at a profit, then which is a good thing, but I still have to pay taxes to the government. And if I don't want to pay taxes, and if I want to accrue all this unrealized gain over the course of my life, if I want to use the compounding to my advantage, then it's way better to let my unrealized gain compound by itself without selling my assets. I hope that I explained in a simple manner, but once you sell, then you have to pay taxes, and those taxes cannot be compounded over the course of your life. But if you just put it there, and if you use buy and hold strategy, over the course of your holding period, the taxes that you don't pay will compound, and it's going to give you huge profit down the road. So that's the point that I wanted to get across. So those are the 4 funding sources that Berkshire Hathaway has. The last topic that I want to touch upon on today's show is the American tailwind. Warren Buffett is a big fan of American businesses, and he always has very positive outlook for American businesses. And a lot of naysayers say that, there's going to be a recession and there's going to be downturn. Yes, there will be downturns for sure at some point. But if you look at 30-year, 40-year time period, even though there's going to be a lot of, gyrations and ups and downs in the stock market, if you look at the long-term trajectory of the stock market, it's going to be upward. That's what Warren Buffett is saying. And Warren Buffett gave out good example. So 77 years ago, in 1942, Warren Buffett made his first investment in an American company with his money, $114. $114 77 years ago. Had he invested this in S&P 500 index fund, then this money would have become approximately $600,000 on January 31st, 2019. So that's approximately 5,288 times more than his initial investment, $114. To put it differently, if you had invested $1 million 77 years ago in S&P 500 index, then by now you would have had $5.3 billion. So what's more surprising is that if once you put some tweak here and you pay annual fee of 1% on your asset, and let's say you just give that to your fund manager and fund advisor, then the final dollar amount that you'd have gotten by now is $2.65 billion, which is approximately half of what you would have gotten if you didn't have to pay that 1% fee. So this 1% makes a huge difference in your final dollar amount. And you might think that 1% is just nothing, but over the course of 70 years, more than 70 years, very long term, 1% is going to cut your final investment amount in half. So that's a surprising fact. And Warren Buffett also mentioned gold investment. He said that had he invested in gold with $114 77 years ago, by now that investment would have become $4,000 as opposed to $600,000 from the stock market. So it's a huge difference. So he's definitely not a big fan of gold, but he's quite a proponent of investing in the stock market in the long term. Okay, so those are the 5 topics that I gleaned from 2018 Berkshire Hathaway annual letter, and I found it very, very interesting and fascinating. Okay, so that's it for today's episode. I hope you learned something out of this episode. I'm going to cover more topics as it relates to Warren Buffett in the future because he's just a legendary investor that we always look up to, and there's just a lot to learn from him. And before I end, I just want you to know that I created a website called shareinvestmentideas.com. And I mentioned this website a couple of times in the past because I uploaded some articles there. I posted some articles there. I think there are about 5 to 6 articles written by me. And you only need your email and your name in order to sign up for the free membership. So just check out the website, and I'm going to put the link in the show notes just in case you want to know exact address, shareinvestmentideas.com. And that's it. I hope you enjoy your day and see you next time.